If you had to bet your life savings on one thing for the next 30 years, what would it be? Gold? Real estate? Stocks? One's been called the eternal store of value. Another is the foundation of wealth. And the third? The undisputed king of returns. But here's the real question. Who is the actual winner? Not in theory, not in hype, but based on 100 years of US data. Today, we're diving deep into the truth. Let's settle this with facts. Hi guys, welcome back. This is The Smart Money. Let's start with the scoreboard. You know, the big, cold, brutal scoreboard of numbers that makes grown investors cry into their dividend checks. Since 1925, here's the average annual return of the big four asset classes. Stocks, all 10.2%, nominal. The MVP, the crowd favorite, the one your uncle swears he would have made millions on if he hadn't sold in '87. Real estate, by 5.3%, home price index, excluding rental yield. Solid, reliable, like that friend who always shows up late but never forgets your birthday. Gold, 4.6%, with major volatility. A bit like your ex. Shiny, dramatic, unpredictable, but somehow you keep checking in on it at 2 a.m. The US dollar? Technically, 2% per year, thanks to inflation. That's right. If cash were a contestant on this show, it would be the one quietly losing every round and still expecting applause. But let's not stop at raw numbers. Oh no, because each of these assets comes with its own baggage, its own vibe, its own Tinder bio. Stocks? Swipe right if you like drama, bull runs, bear markets, and a daily dose of CNBC anxiety. Massive upside if you stay long, and manage not to panic sell when the line wiggles the wrong way. Real estate? Steady, tax-favored, tangible, but also needy. Wants maintenance, attention, and apparently gets real grumpy during interest rate hikes. You don't just buy real estate, you marry it. Gold? Likes long walks during recessions and late-night chats about the Fed. Not really into productivity or cash flow, just kind of sits there. But hey, when the world burns, guess who gets invited to all the doomsday bunkers? Cash? The I just want to feel safe option. The friend-zoned asset. It's always there for you, just quietly evaporating in the background. So yes, the scoreboard gives us numbers, but understanding the personalities behind those numbers? That's how you avoid marrying the wrong asset. Or worse, panic divorcing the right one during a market crash. And if you're already typing "gold never lies" in the comments, we see you, and we'll get to you soon. Stay tuned. Gold. Store of value or speculative asset. Ah, gold. It's shiny, it's biblical, it's what pirates bury in the ground and YouTube gurus bury in your portfolio. Your uncle's convinced it's the only thing that'll survive a zombie apocalypse. You know, when the dollar crashes, at least I'll have something to barter for canned beans. Let's break it down. Pros: hedge against currency collapse, inflation, and Mad Max scenarios. It's physical. You can hold it, hide it, or hoard it. Universally recognized. Even aliens would probably take gold if they land tomorrow, assuming they've watched enough Earth TV. But before you melt your jewelry into bars, consider the cons. Zero yield. Nada. Zip. Your gold bar isn't sending you dividend checks. It just sits there, judging your tech stocks. Price is driven more by fear than fundamentals. When there's panic, gold spikes. When calm returns, it naps harder than your dog after lunch. And let's talk about time. From 1980 to 2000, gold went nowhere. 2 whole decades of financial purgatory. Imagine hodling that without even a meme stock community to cry with. So here's the verdict. Gold shines brightest during chaos. But don't expect it to grow your wealth like stocks or real estate can. Gold is a store of value, not a creator of it. In other words, it's the bunker of investments. Great to have when the world's on fire. But if everything's fine and dandy, you just paid a premium to sit in a luxury panic room with no snacks. But I'm curious, what do you think? Is gold the ultimate safety net, or just an overpriced shiny rock we all agreed not to question? Type Team Gold or Team Growth in the comments. I'll be reading every hot take while polishing my definitely not real gold ring. Real estate. Bricks, mortar, and myth. Real estate. Ah yes, The American dream. A white picket fence, 5.5 kids, and a leaky roof that costs $28,000 to fix. But beyond the nostalgia and HGTV montages, does real estate actually outperform? Let's start with the good stuff. Leverage. With $100,000, you can control a $500,000 asset. Try doing that in the stock market without your broker fainting. Rental income equals actual cash flow. As in, people pay you to live in your property. Shocking, I know. Tax magic, depreciation, mortgage interest, 1031 exchanges. It's like an accountant's Disneyland. You can live in it. No one's curled up next to their gold bar for warmth. Unless things got really weird in 2025. But hang on a second. Here come the reality checks. Maintenance. Toilets break. Tenants call you at 2 a.m. about a squirrel in the attic. Illiquidity. You can't just KTRL plus E a house. Selling takes months, stress, and usually cookies for the open house. Location risk. That beautiful home in a booming area might turn into a ghost town if a Walmart closes or a sinkhole opens up. And after all the costs, repairs, property taxes, HOA fees, insurance, management fees, your amazing passive income might look more like barely breaking even stress management. Verdict? Real estate is great for steady, long-term wealth building. It's the tortoise, not the hare. But don't let Instagram fool you. It's rarely passive. It's hands-on, often messy. And unless you're lucky, it won't make you rich overnight. Still, a well-bought property can be a solid foundation. The question is, are you ready to be a landlord? Or do you just like the idea of owning granite countertops? Comment below if you've ever dealt with a tenant who thought rent due was a suggestion, not a deadline. Or if you're part of #Team Real Estate, defend your bricks with your arguments. Stocks. King of compounding. All right, buckle up. We've arrived at the wildest ride in capitalism, stocks. The only place where your retirement fund and your blood pressure can rise at the exact same time. Now here's the crazy part. Despite all the drama, recessions, crashes, tweets that tanked entire sectors, stocks have delivered the highest long-term returns of any major asset class. Period. Since 1925, U.S. stocks have averaged over 10% per year. That's compound growth on steroids, or on dividends. You buy a small slice of Apple, Microsoft, or even that one AI startup with 5 employees and a dog, and poof, you're now a shareholder. It's like owning a pizza shop without ever touching the dough. Let's hit the pros real quick. Massive historical returns. Dividends that reinvest and snowball. Super liquid. One click and boom, you're out. And you're not just buying stocks, you're buying businesses. Revenue-generating, growing, innovating machines, ideally. But don't let the green candles fool you. Here come the mood swings. Volatility. One week you feel like Warren Buffett. The next? You're Googling, what is a bond fund? Crashes happen. Tech bubble? '08? COVID flash crash? Yeah. Stocks don't always go up. And here's a secret. If you panic sell every time the market sneezes, you will underperform your dog's savings account. Discipline is everything. Stock investing rewards the patient, not the brilliant. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Verdict? If you can handle the emotional roller coaster and resist the urge to check your portfolio more than your ex's Instagram, stocks are hands down the GOAT of long-term wealth building. So tell me in the comments, are you more of a set-it-and-forget-it index fund type? Or do you live for the adrenaline of meme stocks and earnings calls? Inflation and the dollar, the invisible tax. But first, just for a moment, if you feel this video sparked some valuable thoughts, giving it a like would help a lot. And if you subscribe, you'll keep getting content that's just as useful in the future. Ah yes, the good old US dollar. That green piece of paper we trust with our lives, our savings, and somehow still forget it's slowly dying behind our backs. Over the last century, the dollar has lost over 90% of its value. Think about that for a second. If your great-grandpa stashed $100 under his mattress in 1925, today that buys you like 3 eggs, a latte, and maybe half a tank of gas, if you're lucky and live in Kansas. This, my friends, is the invisible tax. No headlines, no breaking news, no protest, just silent theft, drip by drip by drip. Inflation doesn't punch you in the face. It shrinks your wallet when you're not looking. And before you shout, "But I have a savings account," let me ask you this. What's your interest rate? 1%? Maybe 2%? Cool. Inflation is at 3-4%. Or more if you enjoy things like food, rent, or, I don't know, living indoors. So while your money sits there safely, it's actually melting like ice cream in a heat wave. This is why every investment, whether stocks, real estate, crypto, Pokemon cards, or your aunt's Etsy shop, must have one job. Beat inflation. Otherwise, you're not playing defense. You're just slowly losing a game you didn't even know you were in. And hey, I'm curious. How do you hedge against inflation? Gold? Index funds? Buying 500 cans of beans in a bunker? Let me know below. Seriously, I'm still trying to figure out if I should buy more S&P or just barter in olive oil. So who wins? So, after all the punches thrown, charts flashed, and compound interest flexed like a gym bro in January. Who's the real winner? If we're judging by pure returns? Stocks. They're like the flashy knockout artist, sometimes down, but when they hit, they really hit. If it's about emotional comfort and the joy of saying, "This is my house," real estate takes the belt. Because nothing screams financial security like yelling at kids to get off your lawn. And if you're prepping for Mad Max, zombie apocalypses, or a currency collapse, gold is your guy. You can't eat it, but you can stare at it dramatically in your secret bunker. But here's the real plot twist no one on social media will admit. The smartest investors, they don't pick just one. They don't go all in on Tesla, or 100% in land, or buy gold and disappear to the mountains. They diversify, my friend. A little growth, a little stability, a little hedge, like a financial smoothie. Delicious and efficient. So tell me this, in your portfolio boxing ring, who would you bet on? Drop your combo in the comments. Property, stocks, or gold, or all three. Gold, real estate, stocks, each has a role and a risk. The smartest investors, they understand the purpose of each. Not hype, not headlines. Strategy. This was smart money, and we don't guess, we calculate.
Like this video unless you're still Hagel GameStop. Comment with your favorite overpriced stock. Subscribe now, it's free, unlike your last financial decision. Here we diversify our jokes and our portfolios. Smash that like with all your might, we're aiming for 10 subs tonight. Comment like you've seen the crash, your portfolio turned into ash. Subscribe now, don't be late, we fact check memes and track your fate. This ain't your uncle's pump and dump, it's smart money, skip the slump.